Welcome to Chapter 10, Sales and Cash Receipts Journals. Chapter 10, Essential Outcomes. You will be able to record transactions into the Sales and Cash Receipts Special Journals by identifying accounting concepts and practices related to sales and cash receipts for a merchandising business. B. Journalizing sales on account using a sales journal. C. Journalizing cash receipts and recording cash discounts using the cash receipts journal. D. Recording sales, returns, and allowances using a general journal. E. Connecting key terms in the chapter with application. Before we start Chapter 10, we are going to do a review from Chapter 9. As a retail business, we purchase merchandise on account in order to resell to our customers. The first step in the retail business is to purchase the merchandise, usually on account, so that we have merchandise in our store to sell. This merchandise is called inventory and is recorded based on the accounting concept historical cost. The purchase of merchandise on account is recorded in the purchases journal. Purchases is debited and accounts payable is credited. The quality of merchandise. If the merchandise is in good condition, we put it on our shelves in our store and sell it at retail. If the merchandise is damaged, we can request a return and allowance. The purchase, returns, and allowances is recorded in the general journal, and accounts payable will be debited, and purchases, returns, and allowances would be credited. When we go to pay our vendor for the merchandise purchased, we would subtract the purchase's allowance from the original invoice to determine the amount due. So we have marked up our products, put them on our shelves in hopes that customers will purchase the merchandise at the retail price that is set. Meanwhile, our business must pay the bill for purchasing the merchandise on account. Most businesses are offered a purchase discount by the vendor in order to encourage early payment. The terms of the sale may be 2/10, N30. This means that if a business pays within 10 days of the date of the purchase invoice, it gets a 2% discount. After 10 days, it must pay the full price of the invoice. In other words, after 10 days, the discount is no longer valid. When a business pays for merchandise purchased on account, the entry is journalized in the cash payments journal. The account payable amount debited is the invoice price minus any purchase, return, and allowance. Purchases discount is credited for the amount of the purchase discount if it's applicable. The amount credit in the cash column is the difference between the purchase invoice and the purchase discount. Chapter 10, Handling Markup of Products. Once a business has purchased its merchandise, it must decide at what price each item of merchandise will be sold to its customers. A business has to mark up the cost of the merchandise in order to earn a profit. If the business sells their merchandise at cost to its customers, in theory, they would break even. However, the business would actually suffer a loss because it would not have enough money to pay for its operational expenses and would soon go out of business. Thus, a business must mark up its products in order to accomplish two things. One, it wants to pay all of its expenses, and two, the business wants to make a profit. Markup is the increase on the original cost of a product that it will be resold. Example, Tom Harmer Sporting Goods sells Nike and Adidas tennis shoes. In order to get the shoes, Tom Harmer's must purchase them from a manufacturing company, which is a business that sells products to other companies to resell. The purchase price for Tom Harmer's is considered a cost or an expense to the business. Once the shoes are delivered to Tom Harmer's store from the manufacturing company, Tom Harmer stocks his shoes on shelves for sale to their customers. However, before stocking the shelves, Tom Harmer's must decide on what price they will sell these shoes for. Setting the retail price for shoes takes great consideration. You might assume that if Tom Harmer's purchased the shoes for $50 a box and they sold the shoes for $50 a box to their customers, Tom Harmer's would break even. However, if Tom Harmer sells the shoes for the same price they paid the vendor or the manufacturing company, Tom Harmer's will lose money. Why? The reason Tom Harmer's will lose money is because there are a lot of expenses that the company must account for in order to sell their shoes to customers. For example, some of the costs that Tom Harmer's will have to pay are employee wages and benefits, utilities such as lighting, heat and air, and water, insurance to protect against fire, property, etc., etc., office supplies, computers. They have to pay sales tax to the state. These are just a few of the costs that Tom Harmer has to pay for running their business. In order for Tom Harmer's to make a profit, they must add a certain percentage onto the cost of each box of shoes. Determining the markup percent takes careful analysis. If they want to make a profit, they have to cover the cost of running their business, which is their expenses, plus the profit they want to make. There are two general ways to determine the markup of a product: cost markup, retail markup. Cost markup is markup that is determined by the cost of a product. Retail markup is the markup that is determined by the retail price of a product. Note, there are industry standards that set an estimation for businesses to help them with markup of products. Determining the cost markup percent. Each box of shoes costs the business $27.99. The suggested selling or retail price is $93.99. To determine the cost markup percent for each box of shoes, 1. Find the difference between the retail price and the cost. 2. Then divide the difference by the cost per box. Multiply the results by 100%. Determining retail markup percent. Each box of shoes costs the business $27.99. The suggested selling price or retail price is $93.99 a box. To determine the retail markup percent for each box of shoes, 1. Subtract the cost from the selling price or retail price. Divide the difference by retail price per box. Multiply the difference by 100%. Determining dollar cost. To find the dollar cost per box, multiply the unit cost by the cost markup percent. Add the unit cost. Determining retail dollar cost. To find the retail dollar cost per box, divide the unit cost by the difference between 100% and the retail markup percent. It is now time to do your activities for determining markup. Download the Excel project for Chapter 10 from the class website. Save the project workbook to your Chapter 10 folder on your flash drive. There are 4 worksheets that you must complete in the workbook. 3 of those worksheets have extensive directions for you to follow. However, exercise 4 has minimal, since you will have already completed or done previous cost and retail markups. When you finish, show me your work. That's all, folks. You have just completed part 1. Make sure you show me your work before moving on.